that time of the year again when the finance bill makes everyone need to know about taxes. We got you the lowdown. The Finance Bill 2026 has various proposals that aim to raise government revenue by expanding taxation, tightening compliance, and enhancing KRA's enforcement. First up, KRA says it has receipts and it will use them to recover taxes through agency notices. Right now, if there is a tax dispute, businesses have room to challenge assessments before losing access to funds. But under the new proposal, KRA could instruct your bank, SACCO, or even M-Pesa to freeze or transfer money even while your appeal is still ongoing. Thrifting could get more expensive due to the proposed 5% tax on mitumba imports. For importers, this means paying more upfront before bales even hit the market. When import costs rise, they often move down the chain to wholesalers, traders, and eventually everyday buyers. Rent could go up. This is because landlords now face a proposed rise in residential rental tax from 7.5% to 10%. When landlord costs go up, there are usually two options: absorb lower profits or increase rent. In the market for a new phone, Karibia customer. There is a proposed single levy of 25% excise duty on new mobile phones to replace the current regime under which approximately 55% is taxed. The bill wants tax filing deadlines moved forward. For larger companies, this may simply mean tighter timelines to prepare returns, organize books, and manage compliance. But for SMEs and informal businesses, it could mean more pressure, more penalties, and higher compliance costs. Another major proposal is the taxation of undistributed profits. Even if a business keeps profits inside the company for expansion, maybe opening a new branch, hiring staff, or buying equipment, KRA may still assume part of those profits were distributed and tax them like dividends. That completely changes the math for growth for companies. For all you guys who don't carry cash, listen closely. The bill proposes new taxes on card payments, fintech services, and international payment systems. If transaction fees rise due to withholding tax or VAT, businesses may pass those costs to customers, making digital payments more expensive over time. For crypto users and digital asset platforms, stricter reporting rules signal one thing: greater tax visibility. This doesn't necessarily mean higher taxes, but it does mean more oversight and more compliance. For investors, dividend tax changes could also reduce returns, especially for regional investors within East Africa who may now face higher withholding taxes. But it's not all about higher taxes. Businesses dealing with unpaid invoices may now wait 3 years instead of 2 to claim VAT bad debt relief. That isn't good news for businesses, especially in difficult credit environments. The bill also proposes VAT relief for sectors such as solar energy, electric transport, healthcare inputs, and certain infrastructure projects. Financially, that could lower future costs for Kenyans. So what's the takeaway here? The Finance Bill 2026 is creating a broader, stricter, and more aggressive tax system. For the government, that could mean stronger revenue collection, but for businesses, it means tighter margins, heavier compliance, and more pressure on cash flow.